Masterclass lesson 14, price action candlesticks charting, the 24 most popular candlestick formations. I want to explain to you the 24 most powerful candle chart patterns that I've ever seen in bullish versus bearish. The first one is bullish engulfing. The bullish engulfing is where the green candle engulfs or eats away the previous candle's movement. So in this case, there is a small down candle, and then it made this bullish engulfing candle, ate the small one, and basically is saying, nope, we're not going down, we are going up. That is a strong bullish candle. You then have the opposite, which is a bearish engulfing, where you have this big bearish engulfing candle eating the little up candle. Momentum is not going up. We are going down. We are taking over. The sellers are going to win. Let's go, guys. Down we go. So that's the difference between a bullish engulfing and a bearish engulfing. After this, you'll never forget these candle patterns the way I'm explaining. Then you have the Bullish Marubozu. Sounds Zulu. It's Japanese. So the Bullish Marubozu. And this is like an engulfing candle, but the difference is that there are no wicks. So there's no wicks. It is just a complete body of a candle, of an up candle, where the open price is equal to the low and the closing price is equal to the high, and there are no wicks. So that's the Bullish Marubozu formation. Then you have the Bearish Marubozu, where the open price is equal to the high price and the closing price is equal to the low price. And it's basically saying that the bears are winning, the sellers are winning, and the market is more likely to head down. Then we have a Bullish Hammer, which are very common, and very seldom you can make confirmation decisions on whether you're going to buy or sell. But anyway, here it is. A Bullish Hammer is where the open price is equal to the high price is equal to the closed price, and it forms some type of hammer, but saying that the buyers won this candle in this case. And obviously the opposite would be a bearish hammer, where the open price is equal to the high price and there is a closing price of the candle, and in between, so there is a small body and a huge wick, and it looks like a hammer. It's as simple as that. So there is a bullish and bearish, bullish hammer and bearish hammer candlestick formation. We then have the bullish pin bars, and the bullish pin bars is where there are two pretty much identical twins of candles that has formed first the down candle between the open and close, and then the next candle where we have the open and close, and basically they cancel each other out, and it's saying that we are not going down, we are going up. So that's the bullish pin bar. And opposite, we have the bearish pin bar, where not only is it between where the open and close is for the down candle and up candle, but it's also with how big the wick is. So in this case, you can see that the bears won where the candle closed, but the up candle, you can see that the market went down to test that level, failed to break below, closed above, and is showing bullishness to come. Similar with the bearish pin bar, where it formed a bearish candle, the up candle went up, failed to confirm, went back down, and closed above the close. So once again, these are not confirmation candles. These are just names of the candles that you can use. Bullish Harami. So the bullish Harami and the bearish Harami. Harami, as far as I know, means pregnant. And the bullish Harami is basically saying that there is a mother candle. There is a mother candle who's a down candle, and it has just given birth to a baby up candle. That's how I can explain it. So the bullish Harami with the bearish candle, where the mother has given birth to the baby candle, and the baby candle is in between the mother's body. So that's how you can establish of between a bullish Harami. Then we have the bearish Harami, where the mother is an up candle, and it is quite a large candle, and it's given birth to a baby down candle, which is it confirming that there's downside to come? Like I said, do not use individual candles for confirmation. Use other indicators, use momentum, use trend lines, and then take a look and say, all right, boom, there's a bearish Harami. How is it looking in relation to other indicators? The bullish spinning top and the bearish spinning top. So the open is below the closing price for the up candle, but you can see that it looks like a spinning top. The wick between the high and the closing price is very similar to the wick between the open price and the low. Similar to the bearish spinning top, the open has quite a large wick between the high and the open, and the close and the low. So bullish spinning top and bearish spinning top. Dragonfly Doji. This is one of the most bullish candlestick charts that you can get when it comes to trading. And basically it's saying that the price opened at a certain level. Then there was testing and supply where the sellers brought down the price to a certain low. And then it went right back up to the high where it opened, and it closed exactly where the high and the open is. This is a Dragonfly Doji. It's bullish. And it's a good signal sometimes for reversal in a trend. You then have the Gravestone Doji, which is the opposite, where the price opened at a level, the market moved up to a certain high, it went right back down, and it closed at the low, which is also where the open is, and it formed a Gravestone Doji, which can also indicate a reversal of a trend. So if the market's moving up, and then you see a Gravestone Doji, watch out, because we can see a potential change in the trend in the markets. Then we have a hammer and we have a hanging man. So a hammer is now in relation to quite a few candles where the market's coming down at a certain rate, and then a hammer forms, which, as I explained to you earlier, there was a bullish hammer and bearish hammer. In this case, it's a bullish hammer, which indicates that the price was testing the selling, was testing the supply, and then the market moved up, and it closed at the high price, which means that there can be upside to come. Now, these type of candle patterns are amazing for intraday traders if you're looking to trade price action and how candles work. It's also amazing for confirmation for when you are, for example, looking at chart patterns, and a chart pattern forms, and then you see a hammer, which is either confirming a reversal or a potential continuation of a trend. You then have a bearish hanging man, so it's the opposite of a hammer, which basically signals that there is downside to come. The hammer formed, and after the upside trend, it has now formed a hanging man where you can expect downside to come, but always use confirmation indicators to help with your analysis. Then you have a Morningstar Doji. Now, a Morningstar Doji is the price is coming down, and then it forms this doji out of nowhere, where the open price is equal to the closing price. There was testing in the low, there was testing in the high, and this is quite a bullish candle where you can now expect the price to continue up. Similar to an evening doji star, which I find even stronger than a morning doji star, where you can see there is upward momentum, upward trend. It then forms this evening doji star where the open is equal to the close, and there is a form between the low and the high, which can indicate that there will be a reversal in the trend. You then have a morning star, which is very similar to the doji, except there is a little bit of a body. So the morning star, you can see it forms a type of spinning top in a way, but a bullish spinning top. And after a downside in the market, there is a morning star, which should give you morning glory. Did I just say that? It should give you upside momentum for the candles. You then have the evening star, which is the opposite of the morning star, where it forms right at the top of all the candles, and there is bearishness and downside to come, and it indicates that there is a change in the trend. Then we have the piercing line and the dark cloud cover. These are awesome terms, by the way. Piercing line, dark cloud cover. And yet they are the most laborious and boring candlestick patterns in the whole of candlestick charting. But anyway, a piercing line is where there is a down candle, and next to that is a green candle, and where the open price of the up candle is lower than the closing price of the down candle, and the closing price of the up candle is lower than the open price of the down candle. Vice versa with the dark cloud cover, where the open price is lower than the closing price for the down candle, and the open price is lower than the open price for the down candle. So that's a dark cloud cover. The three white soldiers shows you three consecutive grand up candles next to each other with great momentum to show that there is upside to come. These are excellent candles to identify reversal in a trend. The opposite are the three black crows. So the three black crows are showing you three consecutive red candles. These three black crows indicates that there is downside to come. It's bearish.